Hey y'all, welcome back to the Missing Bridge in America. This is episode 21, and we're going to be speaking about a very special topic in particular with what has currently been happening with the bank system and everything that's currently been going on with Silicon Valley Bank and how that may affect you on how you know any concerns that you may have with the banking system and all these other things will be covered in today's episode. But before we get started, I do want to mention if you haven't yet followed our Instagram page at The Missing Bridge, I want you to go ahead and follow. It's an Instagram page where I'm going to be posting a lot of highlights, a lot of announcements, and it's a way that you can keep up to date with the podcast as well. If you're watching on YouTube, Spotify, Apple Podcasts, or any other directory, please like, please follow, please subscribe, and share it to your friends as per usual. If you have any thoughts, if you have any ideas, go to the comment section and you could even DM us on at the missing bridge and we'll be getting back to your message. But without further ado, today's episode is a little different. I'm not going to be recording with a guest. This is something that I've wanted to speak about for a while, and I know it's a little bit more on the later side by the time you're listening to this. Regarding the Silicon Valley Bank collapse, you probably already heard of it. You are probably thinking, what should I be doing with my money? What is it that I should be concerned about? What is it that I should be doing differently? We're going to be covering all that in this episode. But before we get started, that is what I wanted to mention. When it comes to the Silicon Valley Bank collapse specifically, let's first think about what the Silicon Valley Bank is. So, the Silicon Valley Bank pretty much has around half of the country's technology and science companies under its banking system. And so when you're thinking about this, as I was doing research, I found that it was around 2,500 venture capital companies under this specific bank. And so when you're doing research on this, when you're realizing this, and you're seeing that this bank collapsed, you're seeing that the people affected by this were companies. And a lot of companies don't have deposited $100,000 in the bank. They don't have deposited $200,000 in the bank. They have deposited millions and millions of dollars in their bank, at least. With companies, you have to deal with overhead, you have to deal with paying your employees, payroll, all these other things that you have to worry about as a company. And oftentimes when you're a company, you're earning a lot more income than the other person, an individual, right? You're earning a lot more revenue if you have a LLC or a corporation. And so, first things first, realizing this, you can see how impactful the Silicon Valley Bank collapse has been to the market and has been to pretty much what we have seen in all of US history. Because compared to other banks, the Silicon Valley Bank collapse was the second largest bank collapse in US history. And I'm not talking about the last decade. I'm not talking about this is only because COVID is happening. This is only because this is happening. We're dealing with, this happens once a time in a decade, right? But no, this is the second largest in US history, and a lot of people have been saying this has been the largest since 2008, and that was around 15 years ago. So let me explain to you what happened specifically. So what happened with Silicon Valley Bank is that they have so first things first, you have to realize that a bank does not have all their money from their depositors just at their grasp. They don't have the liquid money right there, or the cash in their bank. That's not how banks work. So this is not abnormal for Silicon Valley Bank. Let me just get that out of the way. It is just important to know that your bank only holds a certain portion of the deposits for withdrawals, but other than that, it mostly handles a lot of loans, and it also invests that money. That is not something that's abnormal. That is not something that's unusual. That is something that is common with every bank, and it does not mean that there is just higher risk. That we will be speaking about risk, but that does not mean if your bank does it that you should be concerned about all these different things. But I'll be speaking about that later in the episode. So pretty much what happened is that it had around $175 billion in deposits from its customers. The money, the cash. but the rest was in assets, and a portion of it was in loans. So it had around $200 billion in assets. And what are assets? Those are investments. Putting your money into bonds, putting your money into yields, putting your money into stocks and funds and all these other different things that is not, once again, not abnormal to be done. But what had happened in this case specifically is that this bank put a higher portion, a higher significant portion of their money to a specific U.S. Treasury yield bond that, because of higher interest rates, it yielded a higher loss in the short term and in the long term. Because what happened is that it took a higher risk than usual. It put more money from its depositors into one specific asset that, because the Federal Reserve was raising interest rates, then it ended up being a negative for the firm. So what does this all mean? You may not understand how economics is. I studied economics in FIU in my undergraduate years, and I wouldn't say I'm the most knowledgeable, and I wouldn't say I'm necessarily having the most accurate economic perspective. But I've been doing my research, and if you know basic economics, you'll know and understand how this works. But if you don't, that's why I'm here to explain. So what happened is that if the Federal Reserve is raising interest rates, here's the thing: if you are buying an investment, right? So you are Silicon Valley Bank. You are buying an investment. Let's say Silicon Valley Bank is a regular person, and they are buying a stock, or they are buying a yield. They are buying a bond at around the price of $1,000. So they're buying this bond at $1,000 with an interest rate of 3%. This is not the reality. I'm just giving a hypothetical example. So let's say they're buying this bond for $1,000 and their interest rate is at 3%. So that means that every year that they have this bond, which usually is around 10 years, is this specific bond that they invested into. So let's say they have that 3% interest over the years. They're going to be increasing their $1,000 3% each year for the next 10 years. And that will likely double, if not multiply, the money by the end of those 10 years, right? But what happened is that they invested into a bond that had a lower interest rate once the Federal Reserve increased the interest rates. So they bought a bond at $1,000 at 3%, and all of a sudden, the Federal Reserve decides to increase the interest rates. So now they bought a bond with a 3.3% interest rate. So their percentage profit of what they're going to receive from their investment is still something. But when you're looking at these new investments, these new bonds, where the new interest rates is being implemented, now investors are thinking, I'm going to start going towards that one, right? Because what happens is that you're not going to be going for the one that's 3% anymore. You're easily going to go, if you're going to invest $1,000 into something, you're going to want to go into the one that's 6%, that's 7%, a lot higher than this one specifically. So with that being said, when you are buying this investment, you are expecting people to also be part of that transaction. And so when people are buying into the market and they're starting to buy these assets with a higher interest rates, that lowers your market value for your investment. And so with Silicon Valley Bank, with the US Treasury yield that they had bought, now with the lower interest rate, they were at a negative. So they had bought in the wrong time and they put a lot more money, they risked a lot more in the market than they should have with one specific investment. And now with that market of the US Treasury yields, it was no longer worth as much as the other ones, and it caused a heavy loss in their investments. Could it have been a regular loss? Yeah. Banks always experience losses. It's not something that's uncommon. The difference is that they had put so much money into these investments that it resulted in a loss of around $2 billion. for the company. And if you're thinking about a company that's worth over $400 billion or close to $400 billion at the time of this occurrence, you might think $2 billion isn't a lot of money, right? That's something that can run through a lot of people's heads. But what happens is that when you really think about it, over the past few months, the interest rates have increased almost 1 percentage point. So, but even before in 2022, in early 2022, you had an interest rate of almost nothing, of 0 point something percent, and now you have it at 4.75%. When last year, when it was around 3.75%, just a few months ago last year, right? And so this tightening monetary policy of the Federal Reserve is what really caused this and caused this bank to lose so much money. And when the bank started losing money and the news started to come out that they lost $2 billion in their investment, now the people that are having their money in this bank, right? If you know your bank tomorrow loses $2 billion, what are you gonna do, right? What do you out of fear, out of certain feelings that you have, you're gonna be like, I want to secure some of that money. I'm not saying that is the correct thing to do. At the end of the day, people have their own decisions, and I later this episode we'll talk about why that shouldn't even be a problem. But 25% of people ended up taking out their money from the bank. So 25% of the deposits that were in the bank of the 175 billions were all of a sudden lost within the next 24 hours after that investment happened. So after that huge loss in their investment, around $2 billion, in the next 24 hours they lost around 25% of their total deposits in the bank. And this in economics terms is a bank run. When a lot of people, a significant portion of people, take out and just keep withdrawing money from the bank, where the bank has a lot less money than it did before that happened. And so we're going back to what this means in the macro sense, what it is that caused the bank collapse in the first place, right? So they lost these 25% of their deposits, and that eventually caused a huge, immense loss in their stock. So now their stock was worth 60% less than what it had initially been before they had lost that investment, right? So now all of a sudden a $2 billion loss because of an investment that was really high risk, and just a 1% spike on the interest rate completely plummeted and brought a loss to that investment. Now all of a sudden it resulted in a 60% market decline for that firm, for that bank specifically. So that's how you know the slippery slope domino effect of what was occurring in this situation. And you may be listening to this and you may be like, that makes sense, but it may not make sense. You still may not understand it. And there's a lot of different things that go into it. But what happened is that, let's look at the Federal Reserve. So if we're thinking about the Federal Reserve, what is the Federal Reserve? So the US, in US history, people have wanted to create a central bank. They've always wanted to have someone that can be what they would say is the lender of last resort. And what does that mean? This is a bank that can pretty much cover up commercial banks in a financial panic. They can be the safety net for people that are holding money in these banks and be able to provide for them in a time of need. After the Great Depression in the 1920s, after everything that we had lived in our history, then this was brought about, and it was created, the Federal Reserve, to be able to, what they would envision, end financial panic. Now we know that that's not the case at this point. We face a lot of economic recession, but it does mitigate a lot of risk, and it does mitigate a lot of the damage done with economical declines that we have faced in our U.S. history, right? And so, with that being said, another role of the Federal Reserve, or one of the major roles of the Federal Reserve, beyond helping banks in times of need, is that they regulate the interest rates. So in a time like we are living now, why would you may ask yourself, okay, I may not understand how it is specifically that the interest rates affected the bonds. It could be a little complicated to understand how interest rates affects the stock market. Try to explain it the best as possible, and investments and all those things. But why would the Federal Reserve increase interest rates, and why has it increased interest rates? The reason why it increases interest rates is that when we're dealing in a time of history where there has been so much inflation happening, right? So the long-term average of inflation is 4%. And right now we're at 6%. It's not the highest we've been in the past 2 years. I believe the highest was like 7%, around that, give or take. But we're at 6%. That's 2 percentage points higher than what the average inflation rate is. So we're experiencing high increases of inflation. So just think of it in a simple terms. So if you are buying a product, right? You are buying a product for $2, right? And the bank lends you $2 to be able to buy that product. And the interest rate is 3%. So the bank is lending you $2 to buy that chocolate bar or whatever. And now all of a sudden, to pay that loan bank to pay that loan back, it's actually a lot less than what you would have to be paying in order for the market, in order for you to fully pay off that debt, right? And so when interest rates are low like that, it incentivizes people to be spending money. It incentivizes people to have more debt, to have more money in their pockets, so that when they're actually buying things, over the course of years and over the course of all these months, they're not racking up more debt, in a sense. And that's just one example. But when you increase interest rates, you are withholding people. You are tightening, what some a term in economics is, that you are tightening monetary policy. And what happens with that is that now people are thinking twice before getting a loan. People are thinking twice because now they're thinking, if I get this loan, interest rates are high. In the next 2 years, my loan is going to be significantly higher than when it was lower interest rates, right? And that's not the only thing that's affected by it. Stocks are affected by interest rates and all these other different things. But that's why, to contain inflation, to assist in stopping or mitigating inflation, the Federal Reserve have these meetings every few months to discuss whether they're going to increase the interest rate, whether they're going to lower the interest rate. And in a time of history where the inflation rate has been up so high, then now all of a sudden you're thinking, we should definitely increase interest rates, because that will contain people from buying things. And now if you're containing people from buying things, that will lower the demand of products, and then therefore that will increase the demand of products, and therefore it will lower prices, pretty much. Because if less people are buying products in a market, now all of a sudden people and stores are going to be like, I have to increase, I have to lower my product costs in order for people to start buying. Because now that these interest rates are high, people are not wanting to buy, so I'm going to have to lower the price of certain things, so that then I'll still be able to meet the demands of the people. So that's pretty much how it works in the economic sense. And that's the reason why this has been a whole thing. So now, looking at the losses and looking at all these different things, what does it really mean for those who were banking with the Silicon Valley Bank? So that's where the FDIC comes in. And you've been hearing that from everywhere. And if you didn't hear it from here, you probably heard it from somewhere else, simply because of what's happened now. But it's good, because now you're probably more knowledgeable about it than you otherwise were. At least I was. So the FDIC is a Federal Deposit Insurance Corporation. And if you've probably seen this logo in a check, you've seen this logo when you go to the bank, you've seen this logo a bunch of different places, right? You just don't realize it. But what this corporation is, it's a government entity. It's a government agency that it pretty much supplies insurance to banks. That's pretty much what it is. It supplies insurance to banks so that in a time of economic loss, or in a time where the bank is failing, like the Silicon Valley Bank, they're able to insure a customer like you and I someone that has deposited money in a bank, they are able to ensure that that money is given back to them as it initially was. Let's go back to what we were talking about before. Banks don't hold all your money. Banks give out loans, banks give out investments. So all of a sudden those investments go down. All of a sudden these people are not paying back their loans, which is not that common because normally there is risk management in firms and you're not going to experience such losses like the Silicon Valley Bank. This is a different case scenario. There's a reason why this is the second largest in US history and it's just happening recently. It's not that this is a common thing that happens all the time, right? So you normally have these risk management, right? But in a worst case scenario, you're losing people from paying back their loans, and now you're also losing money in investments, and you start losing money like what happened with Silicon Valley Bank. That's where the FDIC comes in, and it ensures that that you are able to get your money back. Now the catch is that you can only recover $250,000 of what you had deposited in a bank. Now, if you're talking about you and I, probably the people listening to this podcast, you're probably not affected by it, right? And if you are, then, it is what it is, right? But most people, the average American, does not have $250,000 in their bank account. So if you're in a bank that is a commercial bank, like a Wells Fargo, Chase, AT&T, Chase, Bank of America, all these different banks, then what you're gonna start seeing is that I'm insured by the FDIC. All these banks are insured by the FDIC. I shouldn't have anything to worry about, right? But with Silicon Valley Bank, the difference was that, remember, we're dealing with companies. They're dealing with corporations. They're dealing with businesses. Where $250,000 is like $1,000 for them. It's like $10,000 for them, or even less. So when you're thinking about it, according to the statistics, not two, but 94% of those that were under the Silicon Valley Bank had deposits over $250,000. So now that raised a lot of concerns, and I say raised because it's no longer the case. It raised a lot of concerns because then you're thinking, wow, only 6% are going to be able to recover their funds. This is a huge loss for the economy because now all these businesses are going to go bankrupt. All these businesses are going to be losing money because of the Silicon Valley Bank. But luckily, the FDIC, although technically speaking, it will only recover $250,000 of what you deposit into a bank, that's the guarantee. So that is not the necessary limit, but that is the guarantee to all. The guarantee to all is that they can recover $250,000 of all the banks, of any bank that ever collapses. They can recover that much. That's the estimated amount that they chose to put. But in a situation like this, where the only one we're really facing right now is this. I know there's been other banks that have been facing similar things, but this has been the biggest case scenario right now. What you're thinking about is that now the FDIC, they decided to recover all of the deposits of these companies. And in my opinion, that was a good decision on their part. Not because that the government is supposed to bail out these banks and help them survive and be the safety net, because that's not something that I believe is the right in all cases. But in a situation like this, where you're dealing with $250,000 $2,500 companies within a bank, and 94% of them have way more than $250,000 deposited into that bank, you're going to want to try your best to recover them. Because if you can only recover $250,000, that will do a huge negative to the U.S. economy. Because now it's pretty much like a death sentence to all these banks if you're not recovering more than that. And I'm not saying it's the government's job, but the Silicon Valley Bank already made their mistakes. They already experienced their losses. They're not likely going to recover from this. So now it is really the bank's job, the plan B, and how they say in the, before when the Federal Reserve was created, the lender of last resort. This is not the lender of last resort, but this is more of the, well, it pretty much is that, right? Because to an extent, they are lending this money to the banks. They're lending this favor to the banks, when we really don't have to, because they only guarantee $250,000. So this is so much that has happened recently, but it's always important to know that your bank doesn't have all your money. Your bank does not have all your money. It sometimes puts it in loans. It sometimes puts it in investments. That's not something that's abnormal. Now, something that really surprised me in my research was because I thought this amount was higher, but according to the Federal Reserve, a bank only really needs to have 10% liquid assets, liquid cash. It only needs to have 10% cash of the customers' deposits in their bank to be able to pretty much sustain themselves. The rest, 90%, 80%, 70%, 60% in some cases, but a lot more than that, is in loans, is in investments, it's in all those things. But most of the time, it's really diversified. It's really diversified to the extent that banks are making money off of this. The Silicon Valley Bank previously was making billions of dollars in their investments, and that's how they're able to grow as well. It's not just that they're able to provide for their customers, but they're able to grow as well. And that's how all banks grow. Because if not, if they were just managing money, then who's going to pay their bills? Who's going to pay their overhead? Who's going to pay their employees, right? Then a bank is not going to be able to perform. They're not just providing a service to provide a service. They're in it to make money as well. And understandably so, they're a corporation. They need to be paying these people in order to be able to sustain themselves, right? So it's in their best interest to make money. And, to make money off people, to make money of all these things. We're not talking about any moral thing right now. We're just talking about the fact that these companies are in it to provide for their customers and to make increase in money. So it's not in their interest to be in this position that Silicon Valley Bank is. And there really isn't a profit. There really isn't like a sub positive for these people in the board of directors and in the high positions of this company. They're all of a sudden their company is being destroyed by this. So any other perspective you may have had, it's really hard to think of a benefit of these people trying to gain more money, and then all of a sudden they're the second biggest collapse in U.S. history. It's just hard to think that they had such ulterior motives that this was their objective. I don't think this would be anyone's objective, even if they're in it for themselves, which you never know if they are, right? But it's important to not panic. In times like these, it's important to not panic. It's important to not just say, I'm going to withdraw my money. I'm going to tell everybody to withdraw their money, because what happens is that now all these companies, Wells Fargo, Chase, Bank of America, Citibank, all these companies, if a bunch of people are withdrawing their money, then these companies will start to experience similar things. Now, it may not be as grave. It actually probably won't be as grave. And in fact, with so much research done, with so much news that's already out, people are probably already realizing that that's not the step they need to take. But these bank runs do result in heavier losses for the company and for the banking industry, because now when people are taking away their money, the bank doesn't have that much money left to give out to loans, to give out to investments, and all of a sudden it's just not going to be beneficial. So you want to help the economy, you want to help yourself, you are insured by the FDIC if you are in a bank that's insured by the FDIC. And if you know what the bank is, if someone knows what the bank is, like a Wells Fargo, a very well-known bank like that, it's 9 times out of 10 insured by the FDIC. So you don't have to worry about, even in the worst case scenario, that Wells Fargo, that all these companies, all of a sudden tomorrow, they experience one of the worst losses in U.S. history, which is not going to happen. It's just not going to happen. But if it does, for whatever reason, you don't have to worry about it if you have under $250,000 in the bank. So there's no need to be decreasing your money. There's no need to be withdrawing your money, not decreasing your money. Always increase your money. Always increase your income. But there's no need to be taking away your money. The only thing that I'd say you could really think of as a loss is the investors, the stock investors. So the people that invested in Silicon Valley Bank, right? You can invest in Apple, you can invest in Netflix, you can invest in all these companies. I feel like the real losers of this whole thing, more than anything, because now all these customers of Silicon Valley Bank are getting their money back. Let's not talk about them. The real losers are the people that invested in the stock market. And all of a sudden, they're invested in Silicon Valley Bank. That company lost 60% of their stock market value in 24 hours, right? So that's important to think about as well. If you're looking into investments, if you're looking into certain things, and just this may be a realization that it's important to not put your eggs in one basket. And this is not financial advice, this is just my opinion. But if you're looking into doing investments, maybe it's important to rethink if you're going to be, investing so much money into banks like these. If you have a more diversified portfolio, maybe you go for index funds, you go for mutual funds, you go for things that have a little bit more, they have a little bit more balance to it, that you have more risk management to it than just one company. If you are gonna invest in one company, then perhaps you want to diversify your assets so that this is not something that gravely affects your economy, and all of a sudden people had all their money in Silicon Valley Bank in the stock market, and all of a sudden it's down to like nothing. Doesn't mean that you don't have any money from it, but if you invested $1,000 into the Silicon Valley Bank, you invested in the stock market, you probably only have like $30 now. That's an estimate. I don't really know what it is at the moment, but that's just something to think about. It's really the real trouble and the real danger to all this, or I guess like the real reason why this could ever be concerning in any case scenario, is that if one day, hopefully we never reach that day, but if one day many banks are failing, so it's not just Silicon Valley Bank, but it's another bank and another bank and another bank, and I'm talking like significantly well-known banks, or banks that have significant amounts of money. If these banks start failing, then the FDIC won't be able to secure every one of their funds. So the bailout, what some would consider a bailout, what the FDIC is doing with this specific company, that now they're recovering all their assets to the customers, it's mainly because this is really the major thing that's happening at the moment. But if there were a lot of other banks that were closing down, they probably could only do 250,000. And in worst case scenarios, they might not even be able to do that. But that's in the worst case scenario, apocalypse, everything's breaking down, pandemic comes again, all these different things. I'm pretty sure so many things have to happen at once for that to be the case, that they can no longer insure $250,000. But one thing you can learn from this is that if you're investing in stocks, maybe don't put it in one single stock. Don't put all your investments in one single bank. And also, on top of that, if you are someone that is aspiring to make more money, and you eventually see yourself making more than $250,000, God willing, all of us would want to be making that amount of money. It's important that you would want to have no more than $250,000 in each individual bank that you have, because once you reach that limit, you're no longer FDIC insured for that extra dollar, that extra $100,000, that extra $10,000. So just for safety purposes, and in the outlier worst case scenario situation that we're experiencing with Silicon Valley Bank, where it really isn't the worst case scenario, because at the end of the day, these people are still recovering their assets in full. But if the FDIC was like, no, we're just doing the maximum, that's the only thing that was guaranteed, right? In those case scenarios, you would want to really only put $250,000 or less in every single bank that you have, and diversify it as much as possible, so that if you do end up making a lot more money than that, you don't really have to worry about this being a problem ever, really, ever. And another thing is to do your research. Do your research on your bank. Do your research, whatever bank it is. You want to be in the know. You want to be that person that if for whatever reason this goes down, and you know for a fact that you're FDIC insured, that you don't have more than $250,000, at least you know what to expect from it. Because according to what I was reading, this has been something that was going on in the past year. That there was just a huge decline that was happening with the Silicon Valley Bank. A lot of people were dismissing it. A lot of people weren't as knowledgeable of it. The Federal Reserve knew about it. The Federal Reserve knew that this was something that was concerning, because they were taking really grave risks on their investments that could really, really benefit their customers, but then in the worst case scenario, which is what happened now, could really do the opposite, right? And so with everything that happened, you just have to remember that that's something to realize as well. That's something to always look back on. That you should do your research. You should do your research on your banks. You should do your research on whatever investments you do have, and always be in the know with what the market is saying. Luckily, we live in a country where we relatively have, although a boom and bust cycle, we're constantly going up, right? Like your economics professor probably taught you in college or in high school. It's like a boom and bust cycle, but the trajectory is upwards, right? And that's how the U.S. economy works. Fortunately, in other countries, it may not be the case. In some countries, it is. In some countries, it's not. But we are fortunate to live in a country where we can expect the economy to recuperate itself. Um, but with that being said, thank you guys for listening to this podcast. Don't forget to like, subscribe, and follow, and share. We'll see you next time.